Good day, fellow investors. Are you too diversified, where if a stock goes up 50% in the last 6 months, your portfolio still behaves like the market? By the way, ASML tomorrow. Which means you also have too much market risk, therefore you will just perform as the market. In this video, we'll discuss 15 diversified portfolios, and diversified portfolios have been the most of what I received, which means the most of you are extremely diversified. The good and the bad of diversification, or diworsification as would Peter Lynch says, how to solve it, how I am diversified or absolutely concentrated, and then you see whether the way you are doing it now will lead you to your financial goals 10, 20, 30 years down the road. Let's immediately start with the first portfolio here from Caleb, $11,000. Pretty diversified if I look at the ETFs there, which can say, okay, we're going to perform like the market, dividend, Lululemon, a bet, Google, doing well. So a little bit more concentrated there, but I would say, okay, this is a diversified. However, it can be called an educational portfolio. I think Caleb is 22, medical student, learning still about investing, and that's extremely important to do it now, because when he will be rich 10, 20 years from now, there will be much more money, and at that point it will be important to have learned lessons of investing and what drives investment returns. And by having a few positions like this, he will learn over time, okay, what has been good and how can he certainly reach his financial goals in time. Okay, now we have here portfolio number 2, also a lot of positions, but the positions here are rooted into high quality companies with attractive valuations and diversification, good return on invested capital, return on capital employed, mental assessment of the company's durability, so moat, let's say Warren Buffett investment at, let's say, a little bit more of scale. And then if we look at Google, Goldman, this is what we discussed, good dividend, good position, good oil, Meta, hopefully bought earlier, Volkswagen is cheap, diversification with European stocks, Ulta Bet, and then Novo Nordisk, just 2%, ASML 2%, Tencent 2%, Booking 2%, VC 1.4%, Microsoft, SP 500, Nike. So the key question here is, what does this Nike do? If it is 1%, and then even if Nike by a miracle doubles, that's just 1% addition. But it can also be a way, especially if there is, let's say, market turmoil, this portfolio goes down, perhaps even a little bit more than the market. Google now is a little bit risky. I hope it was bought earlier, but the rest is perhaps even more on the aggressive side. Uber, Ekman has 10-15% in it. So, okay, but the key question here is, what is the benefit of an additional 1% position? Here we have something very interesting, £550 monthly into ETFs, £300 monthly into stocks from the UK. Here is the long-term core portfolio, ETFs, you can see here, diversified, SP 500, all world, some gold, some this, some that. Nothing wrong with that. Here we have the stock market portfolio, Alibaba, doing well, 100% up, total 26% up. And you have these great winners, Meta, things like that. But you can see the total portfolio is up just 26%, because when I look at the total portfolio, it is extremely diversified. And now I see you can buy also fractions of shares with this broker, which is pretty insane. However, the key here is it is not bad. Dollar cost averaging will do well. That is what I would say here. Some things will do better, some things will do less. But as soon as you pass 10 positions, you have been diversified and you will likely follow the market, which is that gain of 26%. No losses, but following the market, which can be very detrimental in negative market scenarios. We have been enjoying a 15-year bull run. Hope it will continue, but you never know. All right, now we have here another diversified portfolio, a little bit more on the defensive. We have India, emerging market, that does higher yield, more cash-like. However, if the yields go up, this goes down. More cash, value factor, some gold, and then Vestas bet on what will Trump decide, I think, Amundi, some Berkshire, some other Novo, Archer Daniel, Umicore, another bet as far as I see, Skatek, we discussed it a while ago, Ambev, something. So again, you see this will not move the needle. This neither. Berkshire 4.6%, now it is expensive. So there is this cash position value. This is not value, we discussed it a while ago. Again, the question here is this too much diversification? We go here. Evolution is a stock that we discussed in December, so it looked like a good, interesting situation. I hope this 14% because it's doubled. I didn't check. There are some businesses, this is from my research platform, a member, so he has started incorporating my ideas into the portfolio. But then again, extremely diversified, done well with some businesses. However, the question is, what is the driver of returns? Here we have another portfolio, a little bit more into my positions, okay, that is then going towards value. But again, you can see here, first it was extremely diversified and now slowly streamlining towards, let's say, value businesses where the driver of returns is not stocks going up, or this looks good now, interesting, or things like that. You can switch slowly over time. You buy the better earnings, the better equity, the better compounding. And that's also my message to all diversified investors. If you want more concentration, you need first to know what you are doing, and then it doesn't have to happen immediately, but you can slowly start turning towards more value. And these businesses, these bets like Puma, if they don't do well, they will simply be a smaller and smaller percentage of the portfolio over time, and then you can see one day if you just want to eliminate or not. But you bought this with the strategy, building on it, learning, so some sell immediately everything, forget about it, some do it more over time. Here we have another portfolio, okay, 18% of Berkshire, I hope it is because it went up, 14% of Google, Alibaba, all stocks that did well. So this might be, okay, I'm investing maximum 10%, and then when it goes up, I leave it there. Nothing wrong there. Mercado Libre. And then we have again a little bit more of diversification with various plays there. An interesting, not that educational portfolio anymore because the numbers are bigger, but over time, dollar cost averaging, adding a little bit should do okay. Even if Berkshire is a great business, Google too, but those might be expensive now. Another portfolio, Berkshire, Daily Journal, Munger, Buffett, Alibaba, and then some other businesses. However, I didn't check the Daily Journal, but I will assume it is also on the expensive side now. So in case the market crashes, you're still holding expensive things. So the diversification increases the expensiveness and actually increases the risks here. Again, another extremely diversified portfolio with a little bit of everything. And this is another comment here. So 16 larger positions, these are the larger positions. And then there is another 150 smaller positions where you simply buy whatever you like. question again is, what is the goal with those 150 positions? Even if there are a few winners there, what will be the benefit to a portfolio? Okay, Berkshire Hathaway has been going up cash, so there is some room for Buffett investing cash, and that is a diversification because the cash should do counter to what's going on. However, it is also losing money, as Buffett again knows. However, here there is again something. If this goes down, there are also S&P 500 puts. I can discuss that in a video next week, I think, how to properly hedge, and you are losing money on that, and you are always hope to lose money on these hedges. So 1, 2, 3, even if this is 150 positions, I would prefer it at 10, let's say, but we are here already talking about 3 pillars, which is then a diversified portfolio with uncorrelated assets, not just stocks. So that's also something to keep in mind. Another very diversified portfolio, this is Intesa, because the stock went up, is doing great, and therefore has a huge pie on it. However, the rest, again, extremely diversified, slowly building towards value. If you can follow it, great. If not, might be a risk. Another diversified portfolio, however, this is a dividend portfolio, so 1.3 million portfolio, and then here you go for yield. And if you're happy with the good yield, which is, what is this, average 4.5, not bad, not stellar. However, if you're happy with this, and if this goes down, you can always reinvest the yields into lower, build on that, and therefore, over time, you should do okay if that is the strategy. However, don't focus on the 1.3 million, focus on what you're earning every month. This 1.3 can be 1.5, can be 800,000 over the year. So again, diversification related to strategy, what you're doing with it. Then we have another diversified portfolio. Some stocks go up, some stocks go down. I don't know most of these stocks, but if you know why you bought them and the strategy there, that is key. Another very diversified portfolio, another 5%, 5.2 gross dividend yield. So interesting approach to things. However, again, if you buy the nominal dividend, you never know what is the risk there. Here are the weight allocations. So diversified, it should do well. We have here another extremely diversified portfolio with some big winners there, and now the question is, do we have to sell these or not? You never know, because you never know where the stock will go next, and that again leads to, okay, why did you buy them? Just because they can go up? What is the driver of returns? Is it dividends, equity, earnings growth? What's the P/E ratio of the portfolio? Or I'm just buying interesting stocks, having fun, and those go up. So that is something we discussed yesterday. What is the driver of returns? Now, when it comes to diversification, what is diversification? Diversification is about finding uncorrelated assets with the same yield. If we go to Ray Dalio's holy grail of diversification, you need to find the number of assets with the same alphas in your portfolio that are uncorrelated. That means that you will have much less risk for the same return. The only little problem with that is that Ray Dalio forgot how you cannot find such assets. You can find some, perhaps, here and there, but not 10 uncorrelated assets for a good return. And that is also why his Bridgewater all-weather portfolios haven't really done great over the last decade, because bonds were yielding 0, stocks were yielding a little bit. Okay, those done well, but then again, the others are not at the same yield, and therefore you don't get the benefits of diversification if all the assets don't yield 10%. Another definition, diversification is a protection against ignorance. It makes very little sense for those who know what they are doing. Ray Dalio knows what he's doing. He's protecting billions for his billion clients and getting huge fees. He's just serving his customer with his strategy. He's a genius for that, but not a great investor according to Buffett. And already if you have 20 stocks, you are likely to have market performance like we have seen here. More on diversification. International stocks, maybe it worked up till the 50s, 60s, Markowitz model portfolios, things like that. But lately, international doesn't exist anymore. Just look at Europe, Japan, S&P 500, excluding Nvidia. That's it. There are some local crashes, but they mostly move in tandem. When it comes to diversification, if you buy something every month, you buy the cheapest of your 30 portfolio things list, you will do well, okay, especially if you tend towards good businesses, situations, and especially if you buy through bad times. Because now we are living in a great market, everything is going up. However, there are often decades where everything is down and it's all based on fundamentals. If your strategy is, okay, I'll just buy what I like over the 20 bad years, dividends, this and compounding, you should do well over time. Another benefit of diversification is no FOMO, no fear of missing out, because if you are truly diversified, you should own some Bitcoin, some this, some that, some I don't know, and therefore you can play with 1-2% on all those things and you feel good, you're cool at the table. I own this, I made so much money there, I made so much money there, I lost so much money there. You don't mention that. When it comes to too much diversification, the key question is, what are the drivers of your returns? What is the key fundamental driver that will lead you to your financial goals down the road? Is it stocks always go up 10% no matter the price I pay? The key question is, what happens when stocks don't go up for a decade or two? And then we can go back to earnings, especially now when things are extremely expensive and most things are overvalued. It is bad to be diversified from a risk-reward perspective. Of course, if stocks go up, if the Fed starts buying stocks, okay, at least you are hedged with a Fed put. This is an article from a young, smart guy from 2016, and he discussed Apple for the next 40 years. It was almost 10 years ago. He said it is a buy. Since then, it has done 800%. Okay. He still didn't know much about diversification. He made mistakes then, but just holding it here, there is a huge difference between 2, 6, 10 and 20% of your portfolio. How much do you know is key. This guy back then didn't know. He was smart, had a lot of potential, but wasn't smart enough. Nevertheless, if we go to the Intelligent Investor summary videos that I've made, 10 to 30 stocks is what Graham recommends for the defensive investor, but he recommends absolute concentration for the enterprising investor. Which leads us to, are we diversifying or diversifying our portfolio, as would Lynch say? Because what Peter Lynch says is that by adding less quality to your portfolio, you're actually lowering the quality of the whole of the portfolio. And by the way, I think this is a 2000 edition. I think now is a great time to read this book on Peter Lynch. If you have 1-2% of those positions, 10-20% of the portfolio, it becomes just a gamble. If it doubles, you increase your portfolio 10%. If it crashes, you lose 70%. That's the risk and reward, not the key driver of returns. But it is fun. I just typed stocks to buy and there is plenty of that on YouTube. Every day you can find some ideas to buy this, buy that. Jeremy is still alive. Okay, interesting. But there is always some interesting bull teases that you can buy, add to your portfolio. However, that is not how a value investor should reach his highest possible level of wealth in 10-20 years. Because yes, stocks go up, but stocks also don't go anywhere for a decade, which is when all these guys have to survive. And stocks might go up if governments keeps on borrowing like there is no tomorrow, the Fed lowers rates, target rates are 2% no matter inflation. If there is inflation, businesses are again better to own. And then if worst comes, the Bank of Japan, Fed, everyone will start buying stocks to save your pension or whatever, to make you feel good and to make the politicians win the elections. That is one driver of returns, but you have to see whether that driver of returns is something you want to base your wealth level down the road. And we can see Bank of Japan now owns, 5% of the Japanese stock market, which is insane. Now, what is the ugly of diversification? The ugly of diversification is that if there is a market risk materializing, everything here goes down ugly. You can have this, but imagine what people back then survived. 51% after a decade down. You lose faith already here into everything. Imagine the second time it happens. And if that is going forward, then it will be ugly. As I always say, again, the driver of returns, fundamentals, earnings, compounding, compared to the price you are paying. How much diversification is enough as long as you can find great investments? Let me show you my portfolios. So if you go to my research platform, we have diversified, personal, and model portfolio that represents the research platform ideas. This is the diversified. Keep in mind, this is an educational portfolio. I think that, as Walter Schloss used to say, you need to own a stock to know it. So this is my idea generating portfolio. Started April last year. I'm doing okay with it. I think I paid $100 of fees because these are small positions, as I said, educational, and some people want more of these ideas. We follow it, and for now it's been doing good. 15% up, 20% without the fees, which means, okay, in line with the market, I think, over the last year. And you can see here the exposures. Bought Alibaba at the beginning, and now it's up more than 100%. ADM doing well. Amsterdam Commodities also doing well. So those are the stocks we pretty much also discussed here on YouTube. And then there are others, 2% more risk, and I'm ready to buy more if it comes to a no risk, higher upside scenario. This is the model portfolio. Started with 5K in 2018, 25K after the restructuring, and we are adding 250 euros per month. And you can see 25K 3 years ago, dividends, earnings, compounding. We are now at almost doubling our money in, 3 years and a few months. So that is my driver of returns. I don't care what the market will do, I try to focus on that. And you can see here, I focus on the better I have, depends on the quality. My target here is to go maximum 40% into a good position, and then I hope I find others that are also there. My personal portfolio, all in one stock, and this is my one position, but if I can keep adding every year, then this position should be, I'm looking at it, this is, I don't know, 500K on 10 million down the road is just 5%. So I diversify over time, and I'll always focus on buying the best I can find that year, that few years. Over a decade, I should have a great portfolio. That's my plan there. Of course, if you want to check it all, feel free to do it. To get also context on what we are doing, 21-day money-back guarantee, just send me an email. If the strategy, if the driver of returns is not something that fits your long-term wealth goals. Now, how to solve the diversification problem is something I often get asked, because when people rush to buy, they usually also rush to sell, which, okay, you can do as you prefer. But you need to focus on knowledge, build a new value investing portfolio slowly. You can keep the old portfolio and build a new. Over time, the better will take over the bad, and you will know what's going on. You follow companies, you have a list of 20, 30 stocks, buy more of the better over time. Give it a decade, and you might again check what I do. I have a list where I do the work for you. Earnings are coming up, we'll update on that, and that's it. Similarly, more focus, Buffett 85 business portfolio. Geico was 50% back then. Smaller positions there. Washington Post kept till Bezos bought it. And you can see here how the rest is simply history. The key when it comes to diversification, when you start knowing, when you find the right vehicle, just pound on it. That's my message. As long as you don't know, keep dollar cost averaging, keep buying, keep adding to your portfolio, and keep learning. Build a list, start thinking about value, subscribe to this channel, check more on what I do, and I'll see you in the next video.